Uh, so we know many of you in the crowd, and you heard from Chad yesterday on who we are. Bryan Accounting and Consulting. We're outsourced CFOs to many independent dealers. But we're here to focus on what's important to you all today from a finance, an accounting, maybe even an operational standpoint. And you can see our agenda on screen. So we get the benefit of viewing activity and performance of a kind of widespread dealer base. So today we encourage an open forum, kind of like we've seen the last day or so. Please speak up, share your thoughts, ask questions. We'll try to get them answered. So we're going to go through, we have more than 45 minutes of content, and at this point, less than 45 minutes. We're going to try to knock them down in level of priority. Tax topics, deal structure profitability, cash flow management, and if we kind of work through this, some best practice tidbits from our standpoint, and then some more accounting-related topics, internal controls, and some rule changes. So I'm going to talk for a few minutes before we kind of invite Chad in, but I want to kick us off by jumping right into one of the heavier topics, and that is bonus depreciation. I think many of us here probably know what it is, or we've heard of it, and know that it's set to they call it sunset. It's set to taper off over the course of the next few years. But what does that exactly look like for us taxation-wise if we've elected bonus? So that's what we want to chew on today. So I guess maybe a quick show of hands, who knows what bonus is? If you don't, it's okay. Okay, a few of us do. One more question, who is electing bonus in their tax return? Does anyone know that? And that's okay if you're unsure. So it's one of the benefits that's mentioned almost first and foremost when talking about the leasing model. And so quick recap before we jump into a few examples. So the Trump Tax Act of 2018 allowed for 100% tax deductibility to be taken on qualified property, like our units that we buy and put into service. And so so that runs through the end of 2022, at which point that 100% goes down by 20% each year until it gets to zero in 2027. My guess is a lot of dealers in this room during the pandemic actually did okay despite all the volatility. We generated some income, but I'm also guessing if you elected bonus, you weren't a taxpayer, right, during that time. And so, if you bought and put into service 500 units at $10,000 all in, that's $5 million of taxable write-off, right? So we're generating these large loss carry-forwards that we can use in the future when we are going to become a taxpayer. So if we're generating this income in the business, we're deferring all these taxes, not eliminating it. Well, that day is going to come when we will be a taxpayer. And so we've gotten so comfortable not being a taxpayer, I think, for many of us who've elected bonus, that it's going to be uncomfortable when that day comes. So let's see what this could look like for a few different size dealers and dealers kind of in different stages in their life cycle. So this is going to be a little bit overwhelming to understand at a granular level. So let's keep it high level and just kind of try to understand the concepts and where we might fit in some of these examples. And so what I'm going to look at first, let me caveat this with there are a lot of assumptions, and these are general examples, so it could be better nailed down on kind of a dealer-by-dealer basis. So I'm going to start with this dealer that we call the 1,000 account dealer that, during the pandemic was buying and leasing, 500 plus new units a year, which is the third line down. And with cost pressure and no stimulus, starting in, say, 2022, they moved down toward a new norm of buying about 350 new units a year and backfilling their program with recycles, right? So over time, their 1,000 accounts became 600 to 700. So at the top, you kind of see a few of the metrics, assumptions that we've made, the ACV, that's rising, the new units leased, the units disposed of, and then what we're going to call this tax gain on sale. I'm going to talk about that here in a moment. And so kind of following top to bottom, when a tax preparer does your tax return, generally what they do is they start with your book income. So that's what you report in your monthly statements or your audit or review or compilation. And then from there, they factor in tax differences. So you see the book income number down, 5, 6 lines down. And then they factor in tax differences to get to your taxable income or loss. And for many of us in this room, at the car company corporate level, there are 2 major differences. You've got depreciation expense, which is bonus. You don't take that in your books. You take it for tax. And then you've got what we're going to call this gain recapture on sold units. And we'll explain that in a moment. So kind of looking down the screen there, starting in that depreciation area, if we're electing bonus, our deductibility for depreciation is 100% of all those new units we bought and put into a lease. Not the recycled units. We already took bonus on those. And so for this dealer there in 2018, you had 500 new units put into a lease at $9,000 a pop, $4.5 million in bonus depreciation generated. But when we're reducing our book income by this huge number, we have to add back the depreciation we took for book. We can't take both. And it's already 100%, so we can't take 120%. And so that brings us to our net depreciation number. And then we have to factor in these disposal recaptures. And so we have to add back the book loss that we took before we consider our depreciation recapture. And generally, when you, over time, dispose of units from your books, over time, that's generally at a loss. That may have been thrown through a little bit of a loop with pricing the last couple of years, but generally, that's a loss. So we add those back. That's $490,000 there in the 2018 column. But then with bonus, we can't have our cake and eat it too. And what I mean by that is for units that we've already taken 100% bonus on, we've taken every dollar of expense we can take on those units. And so when we get those units back and liquidate them, at auction or receive insurance proceeds, those are 100% taxable. So we get $5,000 at auction from that unit, $5,000 taxable income, no expense to offset. And see, then we get down to our taxable income and loss. And so, I know that's a lot, but take us back up to 5,000 feet here. What are we seeing in this example? Well, for this dealer, they kind of maintained, maybe even grew a little bit when bonus started in 2018. They were buying and putting into service as many units, if not more, as they were disposing of. So they're creating these big bonus depreciation deductions, and they create a loss in the first 4 years for tax purposes that builds to $3.9 million. That's at the end of your 2021 column. But then at that point, they start shrinking. They're disposing of more units than they're buying. Their recapture on selling all those units that we previously took 100% expense on grows. And all of a sudden, we generate taxable income in 2022. That's $750,000. The silver lining is we've got these losses built up, right? And so we start chewing through those, and it's not till 2025 that we become a full-blown taxpayer. And so if you can resonate with this example, you might say, oh, okay, I got a few years. Well, when those losses run out, what we've done all this time is deferred the tax. We haven't eliminated it. Maybe our BHPH counterpart down the road was paying $100,000 a year for this similar performance. And it's going to hit us in a more condensed manner for a few years. And so that may be a little bit uncomfortable. Place in our business cycle where we own more units free and clear, that cash flow for us, or we've used some other strategies like reinsurance to maybe further delay that moment. I'm going to look at 2 more examples. If anybody wants to pause and ask a question, though, please interrupt. You can't. Well, you could underperform. That's one way to do it. But I don't think that's you guys. That's not you guys. So, you know, the.
How far do you got to kick the can? Then I guess you die and then get reborn in Europe somewhere?
Yeah. Yeah, that's a great question, right? You guys, having somewhat plateaued for a while before you enter that new growth cycle, you're generating a lot of income, right? And you're using other tools to delay that day, but it will come. And so you keep strategizing, right? And eventually that moment will come, but you won't be as leveraged. You'll be more cash flow positive. So, yes, Tim.
Starting to build up their reinsurance program now, counting on the potential sales tax that they'll have to pay in the future. Is that going to help offset that tax liability at that point?
Yeah, so you stole one of my next points, so thanks,
Dang
Tim. No, so I guess the point here is, and there'll be a theme a little bit, we're going to quickly look at a couple more examples, but you know, just because you're comfortable knowing that maybe your day is a few years out, doesn't mean you shouldn't strategize now, because that, you know, a program like reinsurance can not only kick the can on a portion of your revenue down, you know, a decade or more, but also lower it to that capital gains rate, right? Whereas you might be paying, you know, 35% rate personally, depending on your circumstances. So let's look at one more. I think a couple can resonate in the room with this example. So this dealer is a 600 account dealer who plateaued in 2018 and just kind of maintained at that point, right when bonus started. And they began shrinking in 2021 due to some of the, you know, cost pressures, cash pressures. But all along they've been generating healthy book income because they're a seasoned business. They know what they're doing well. And so in this example, you can see at the bottom, they become a taxpayer much sooner. They were generating healthy book income. They did take advantage of bonus depreciation here for a few years before it began tapering off, but they were disposing of as many units, if not more, than they were buying. And so they're getting hit by these depreciation recapture gains where they're 100% taxable on any proceeds they get from the unit. And so they generate these losses for the first 2 years, and then it only takes a year or a year plus to chew through the losses before they're a taxpayer, absent other strategies, which I know, you know, some are scrambling to do, right, like reinsurance right now. So it kind of, I think the folks that resonate with this, I've talked to one of them this weekend, it was a surprise, right? And I'm talking about a smart dealer, so. One more. This one kind of excited me to put together. So nerdy. Nerdy tax. We're not tax people, but nerdy accountant. So this is the new dealer in 2022. And we'll call it small to moderate size at 20 units a month. But when I say new dealer, I mean that could be someone opening a storefront for the first time or someone pivoting from a retail installment contract to a lease. And what I wanted to examine here, and I think, Chad, it was your idea actually, so I'll give you credit, is whether the strong federal taxation argument for LHPH of a few years ago when bonus kicked in still holds water today, right, as bonus is set to start to dwindle down in 2023. And the answer is a resounding yes. And so what are we seeing here? Well, for this example dealer, there are a few things working in their favor taxation-wise. Right out of the gate, they're buying far more leases, far more new units than they're disposing of, right? The program's brand new. They don't have that many repos, losses coming through yet. They're not generating a lot of book income. I think we know that for those that have started a leasing program or a retail installment program for that matter. I mean, I think Ed mentioned it earlier. You know, it takes a year plus to stabilize. and maybe you're probably going to take a book loss in that first year. And so we get to take advantage of bonus for at 100% for 1 year, and then continually at a lower percent. And we don't have a lot of these gain recaptures. And so this dealer has taxable loss for 3 years, but they built up enough of the loss carry forward to chew through it for years to come. And so what's cool about that is this dealer has a chance to unlock the real profit in the program and get a full cycle on their leases, on their portfolio, plus, to own more units free and clear that are cash flow positive before their day may come to become a taxpayer. Questions? Yes.
So once the bonus depreciation from the Tax Cuts and Jobs Act sunsets, then are you applying makers depreciation or some other, are you just doing 20%, or are you doing the accelerated makers?
It's double declining, I think, is what you do. So it's kind of double of what a straight line. Like if you said your unit was a 5-year unit, you could take, which would be 20% a year, you could take 40 in year 1. So I didn't get into that in the examples, but it's kind of factored in. So absent some strong lobbyists or a politician that says, let's keep this program up, that'll be the reality. So, awesome. Anyone else on that subject? Yeah. Not, I don't think 100%. I don't believe so. Right. Right. So maybe what's the takeaway here? Well, I didn't show the aggressive growth dealer right now because that dealer is creating a ton of bonus that's creating loss carry forwards that'll take a long time to work through. So if that's you, I didn't bother for the moment. But I guess if you're shrinking, bonuses tapering off, you've plateaued and shrinking, then that may be you that's a taxpayer soon. But if you're growing or you're generating a ton of book income, then if you're growing, then you're probably not a taxpayer for a while. But if you're generating a lot of book income, then that could make you a taxpayer sooner. So it's an individual discussion, but hopefully this gives you a little bit to think about as we go. All right, one more tax topic here before we get into some other kind of profitability type stuff. And Chad, I'll pull you in on this here in a moment. Employee retention credit. I bet most folks have heard that or heard of the term ERC in this room. It became prevalent when every firm in the world saw the opportunity and started reaching out to business owners recently, asking if they could help claim this credit. But let me recap it real quick, and then we can share what we're seeing these days with it. And so back in March 2020, this was part of the stimulus package that came out. It flew under the radar a little bit because PPP, everybody was chasing, right? That was the headliner. But essentially what this program provides is up to $5,000 per employee per quarter credit on wages paid from March 2020 to December 2020, and up to $7,000 per employee per quarter for the quarters in 2021. But one of two things had to happen to your business. You had to have a decline in gross receipts from 2019 to 2020 or 2021 of a certain threshold. I think for 1 year it's 50%. For the next, I think it's 20%. Or you had to be impacted by a full or partial government suspension. And so when we first saw this, few dealers qualified on the merit of declining gross receipts. Most folks with the stimulus in the market maintained or even grew their business. And so that was only a couple folks that we spoke to that qualified there. And then The secondary qualification lane was the full or partial government suspension. And in not many states, this seemed to be prevalent. Most of us were deemed essential businesses, and so we thought the door was shut there. However, some new guidance and interpretation has come out on this concept of full or partial suspension that kind of points to your supply chain being an avenue to qualify yourself for this. And so it's a somewhat gray area, but it's proven to work for a lot of businesses. And so I guess the idea here is if you can find a full or partial suspension somewhere in your supply chain, and think the wide range of your supply chain, right? Your vehicles, your body shops, your GPS providers, your parts providers, whatever it may be, if they're impacted by a full or partial shutdown that trickled down to you, then you have an opportunity to qualify yourself for one or more quarters. And so, Chad, let me pull you in because this still seems like a little bit of a tough area to wrangle in. What have we been seeing recently that has gotten us excited about this?
So I think when we first started talking to firms that are helping put this stuff together, they wanted a dealer to come up with an email, a letter, something that they could kind of hang their hat on that says, hey, our supply chain is disrupted, so we can't get you parts. Or we had to have something. So when we talked to a lot of our clients and said, hey, go back through your emails, none of them really could, right? I mean, they didn't have something from O'Reilly's that said they didn't have it on the shelf, so we couldn't we couldn't get it to you, right? Or they didn't have anything from there. But I recently, so be careful, I guess I would say, because a lot of these firms are just saying, well, if you just document that you had it, we'll file this credit for you. I think that's going to be come back to bite you here very quick, because I think they're going to jump on those types of things. But we've connected with a firm now that has actually taken the time and the due diligence, and they've been around for a long time, to take bills of lading and trace it through the port systems and through the ports here in California or wherever, and they're actually creating a database of different parts, how long they sat here in the port system, how long it took them to get here from China or wherever it came from, and they're building a database, and then their goal is to try to take that information and link it to your dealership in some way. If you sell a particular type of car and you have a lot of recon, they can say, well, those parts were delayed for 6 months here in the port system. So I've got a couple of you dealers actually going to be guinea pigs, and we're going to be connecting with those firms in the next week or two with that firm, and we're going to kind of see how this plays out. But if they're able to actually connect it down to an independent dealer to these parts that we can somehow quantify, I think it opens up the door for most of us probably to apply for that. But it is trying to we want to hang our hat on something. This isn't a spitball and hope we don't get audited. And that's where a lot of these firms are trying to do right now.
Thanks, Chad. Yeah, that's kind of an exciting opportunity. Please. What's up, Brett?
With the notification from the office, letting dealers know they were shut down for periods of time, also something like that.
It adds to the case, and those are things that we'll pull in and put in the file. But I
Right. Right.
I think all of these little disruptions add to the case of the overall and quantifying that we had greater than a 10% disruption, and that 10% is kind of what the number I've been hearing you to quantify. The more things we're going to add it, fill it up.
Sure. I was going to mention that. So let's say you're a business with 20 employees. In 2021, per quarter, you get $7,000, up to $7,000 if you paid that employee that much money. And so, 20 employees times $7,000 is $140,000 per quarter that would be directly in your pocket. You submit it through an amended payroll tax filing, and a few months pass, and the money comes into your account. Yeah, so it's March of 2020, kind of right in the middle of the month when all this, the pandemic was declared, through the end of 2021. So that's, essentially 7 quarters of time. You're good. I hadn't even thought about that question. I mean, we would, so most firms out there charge a somewhat hefty fee, right, to file it anywhere between 10 and 20%. We haven't even talked about, what that could look like for us. But if we can develop a program that that can work for a lot, that gets us excited to roll it out. So.
One more question. The firms that are processing this for us, if they process it and switch everything over in a small print, is there some type of our errors and omissions policy does not cover the fact that we
So one of the firms, we talked to, this is how funny it is. He said, hey, everything looks great. We'll get this paperwork going. He was actually lowballing compared to the industry. I think it was 8 or 9%. Most are in that 12 to 15%.
Or 20, but.
Yeah. But he came back and said, don't worry. If you get audited, we'll give you all of our fee back. And then they just walk away, and you're stuck, trying to defend the audit, and you're stuck with any penalties or interest.
Yeah.
The firm that I was speaking about, their program is 100%. They're your audit guy. They do a lot of other payroll tax credits when it comes to veterans and the different credits that are out there for those things. And they have a 97% audit success rate of upholding whenever they filed for that stuff in the past, for that type of stuff. So they're behind you 100%. So the fee you pay gets you that audit protection on the back end as well.
I mean, I know every new car dealer I know is already done it, and they do their audit.
Mm-hmm.
And they just went for it. I remember when fees would come in, and then they would call me and say, hey, you know a lot of dealers. You want in on this? I'm like, I don't want nothing to do with it.
No.
Said I'd do it if I had a store.
Right.
I don't know if I want to get in there.
Just haven't had the warm and fuzzies up until now to want to roll this out and encourage dealers to do it. But knowing that there's substance behind this program, we're somewhat excited and optimistic.
Yeah.
Yeah.
Mm-hmm. No, it's part of the argument to supplement the real teeth of this, which is some sort of suspension impacted the trickle-down effect to you. And so I heard all the metrics thrown out over here, and everybody went through it. But in the end, you got to have that linchpin, right? And that's why we're talking about, tracing bill ladings through port systems. Like somewhere else, there was this suspension that trickled down
And
to
I would
us.
say if anybody has anything in their email box,
Yeah,
and they would
that's
love
a
to
slam
offer it
dunk.
up for the greater good, please reach out to us. But most companies didn't, right? They didn't put anything in writing. There was a lot of disruptions, and I was talking to this firm, a lot of disruptions from bigger manufacturing plants and different things. And they had the disruptions, but nothing was ever put into writing. So there is, I think part of it is if you can show government mandated shutdowns, right, for those types of things, that is something that we can hang our hat on. A lot of those you could still get it. It was delayed, but if some shut down and just stopped for a month or two, then that particular quarter that was shut down. So this is quarter by quarter. So if that's one quarter we could file for. We're trying to pull in all 7 quarters with something. But that's a perfect example. Good call. Yeah. Go ahead.
That's a great point. You can do it. You're just, for whatever quarter that you qualify for this, if you also had PPP forgiven, they take it out of your total dollar. But But you can still do both overall. So, good question. Yeah, you're good.
Given time, is there a direct correlation between the impact of the supply chain disruption and the magnitude of the payroll taxes you're, just if you had a problem,
Yep.
then you can.
Yes.
Wow.
There are a lot of folks out there that aggressively pursued this. If you were aggressive, you would not be the most egregious one. Yeah, by any stretch. It's 50% for 20, I think, and 20% for 2021. So be happy to talk more offline. Okay, moving on. We're already running out of time here, but these are good subjects. So I'm not going to get into reinsurance because we have a panel on that next, but do encourage that you use that as a tax strategy if it makes sense for your business, both operationally and tax-wise. Don't forget about it, even if you're not going to become a taxpayer anytime soon. Okay, we'll get a little bit into this. I don't know how much time we'll have, but we want to copyright a game show and play a little game here called Deal or No Deal Structure. And so in my mind, think about your business as it currently stands. Before we even consider whether your overhead type expenses are commensurate with your size and your situation, what about your deal structure? Do we have a business model that works, a deal structure that works at your recovery rate? And so before we jump in, let me just disclaim, these are general examples. Everybody's market and approach is different. We can't possibly, consider every variable or dollar. But I just want to get our mind going and talk about some pros and cons of different deal structures. So you see some of our disclaimers there on screen. So let's jump right in. We're going to start on the left side of the screen. I'm not a marketing specialist, so this is kind of dry, but let's work through it here. So chat and audience, I'm going to cue you up here as we go. So first up on the left side of the screen, we've got a $10,000 ACV, agreed upon selling price $15,000, $1,250 down, residual of $4,200, customer payment $451 net of sales tax, lender payment that amortizes with the loan of $323. And so I guess Chad or anyone else, what are we seeing in here? Do we like this deal or do we not? And let me mention one more thing. At the bottom there, we have assumed deal metrics. What are you recovering at? What's your recovery in excess of your cash in deal? How much principal are you recovering in excess of your risk on the street? And then your spread between what you're receiving from the customer and what you're paying your lender. So deal or no deal, what are we seeing?
Audience first. So what do you guys see here? 75% collateral recovery rate. They collected $2,000 more in principal in excess of their cash-in deal, and they have a $129 spread right now between this customer's payment and the lender. Is this something you guys would put on the street? Not all at once. Kelly, deal or no deal? Anybody else disagree? Second the deal.
Second the deal.
Sold.
So,
Yes, Tim. Oh, you second. I thought that came from over there. I didn't hear that. I think we would all do this all day long. The spread maybe a little low, but doable. I wouldn't mind seeing that a little higher. But 75% collateral recovery rate, I think I'd take that all day long on this. Any questions? Did we miss something?
okay, let's look at the next one on the right side of the screen. So this one is almost the same selling price, $14,000, but it's called $7,500 all-in ACV. So we got a steep markup, similar residual value as a percent, same down payment. And then our monthly pay is just slightly lower because the selling price is slightly lower. So the deal metrics for this one work out to be a much lower recovery rate, 50%, $750 CRR in excess of the cash in deal, but a spread of $177. What do we think, guys?
I think Rick Reeves says no, based on that face. Making some good money, though, on the spread. We can pay our bills.
For how long?
Huh? No, I think the key here, yes, is the collateral recovery, right? You're putting, yeah, you're putting some fake money on the road. You're kidding yourself. You probably grossed up, or your selling price too high. So I think you're missing out on some competitive advantage on your selling price, but you're just not collecting it.
That collateral recovery rate, is that a recycled hit, or is that taken into option?
It is assuming, I don't know what we
Either.
have our.
It doesn't matter. Your
Okay.
recovery ACV will be what it'll be, whether you put it back in at, your fair market or you liquidate it for actual value.
So that the recovery rate is based on the market value of the car at the time it's sold, or it's based on the
No, the market value of the car at the time is how we would have done
It's
it.
essentially measuring what percentage of every dollar amount financed you collect in the end. So,
Yes.
Yep.
Not
Yep.
just the value at the end, yes. So this isn't a recovery rate. Yeah.
total principal collected rate. So, if this was a 70-cent CRR, 70% recovery rate, this might be a different story, right? Significantly different story.
Yes, sir.
You think collateral recovery rate is percent, you're saying it's that $14,000, right?
No, so if we were to sell this car, looking at the thing, it's roughly amount financed is 13,000, let's just say. Or for simple terms, let's just say we had an amount financed of 10,000, and we collect $4,000 of payments from the customer, and the
Principal.
car had a $3,500 wholesale value at the end of it, or market value. We collected $7,500 out of that 10. We get to a 75% collateral recovery rate. That's what that is measuring. It's not measuring interest you collected, that kind of money. It's strictly on the principal, or principal equivalent for a lease. Say that again.
Tell that our customer again, right, when you're overcharging them,
Right.
your collection rate is lower because you overcharge them, they walk away. So you have less chance of collecting that profit.
Right.
So, I mean, it's really looking at getting a balance between your advance rate with your lender and the collateral recovery rate. I think if your collateral recovery rate was continuously under 50% and you were doing a buy here, pay here on the, so you had those receivables and you were being advanced 60, but your collateral recovery rate 50, you're not going to have that lender for too long.
It's a broken model.
Huh?
That's a broken model.
It's a broken
That's not going to
model
work.
at that point. So it's a little different with the way, some lenders, might lend on the car or whatever, but it's just understanding that, how to pull the different levers to, in some way you can, I don't want to say you can manufacture CRR, but you can make it look really out of whack by having such a 100% markup versus maybe a 70% markup. Obviously extending a customer in the car and keeping them in longer, you collect more, raises your CRR. So it's just understanding how the different levers you can pull raises those numbers and those metrics that your banks want to see, or maybe new banks that you're trying to get financing with want to see.
But
What do you guys think the average spread should be percentage-wise? What's a good number?
that's a great question. And Joe mentioned it yesterday, and I heard him mention it before. I don't think he's still here, but he would say, and I didn't think about this till he did, if your spread's under $100, and you're a growing business, without a lot of sideline capital, then don't bother. I like the 150 number. What do you think?
Yeah, but north of 150 is what ideal.
Sure.
Well, I think it goes the reverse, right? On a higher car, you may have lower markup, and your spread actually might be a little less. Am I correct, Tim? On a percentage basis, yeah. I took it as payment spread. Or were you talking about cash and deal and CRR? Okay.
Yeah. Let's keep moving a little bit. Maybe can we get through the last couple examples here before or 6 minutes? Okay. We'll take 5. Okay, these are a little bit more extreme examples we want to walk through. We're going to start on the left side of the screen. And so who here has had cost creep in the last 2-3 years? So this ACV is 15 grand, lower markup just to 19.9. And I'm going to go right down to it. So $1,400 down payment, a little higher monthly payment, obviously bigger ACV. And then you see our recovery rates are spread between recovery and cash in deal and spread with the lender. This may be an easier one for us. What do we think? Okay, no, right? We can move on from this one, but what I wanted to say here is that I think there's some of us in the room that think that I'm not pointing fingers. I think that what could happen in this environment is we've gone up the ACV spectrum and we inherently think that we're recovering better because it's a higher ACV, but we have this double whammy of getting squeezed on markup and we're actually recovering in an inferior manner. And so what happens to that? Well, you can kind of see the fallout there. Last one on the right side of the screen, this is an expensive car, $20,000, a markup of 36%, so 28 all in. Low down, $599 down. Higher recovery rate at 88 cents, moderate spread, and then a big recovery rate in excess. What's interesting about this one?
It's only $700. What's wrong with that?
For sure.
I think this is an extreme. It shows that obviously this model would work. You still have 128 spread between customer and lender. Good metrics overall. But customer payment. Can we really? What type of customer is going to be coming to us that we can expect $700 a pop on? I don't know.
Interesting. And are you going 42 months on that, or have you extended it? 36?
Oh, wow.
Wow. Well, that's.
It's saying we're only not going to collect 12% on that, right, on these, right, the product recovery, because the car's going to hold value here early on. Right.
Then that would be troublesome. That would be a problem. Right. Well, but if you've dabbled in it and you're showing the history, then you might roll it out a little bit more if you have the financial wherewithal. So
I think that there's so many ways to skin the cat, right? We see these so many different deal structures, different levers you can pull and things. I just think we can't get caught up in doing the old school. This is just how we've always done it, right? We've got to think outside the box and model some of this and kind of figure out what's best for us, for each of us.
So we've already run out of time. Wish we could speak more. but I hope that these are thought-provoking a little bit. We appreciate everything. That was last year here, Chad, on the boat. So thanks, everyone. We'll be around the next couple hours if you want to talk at all.